For decades, we have been wired to think that equity means growth and fixed deposit means safety. And what about debt funds? They are always considered as the dull middle child. But here is the irony. Debt mutual funds is exactly where institutional investors, that means where big players like companies, banks, mutual funds, park their money when things get uncertain. Right now, inflation is cooling, but rates are high, equities are expensive, and the next big cycle could be a shift from higher interest rates to the lower, and that is when debt funds shine. But why is that so? Because where economic shifts, the silent money moves into debt and not equities, and 2025 and coming year might just be that moment. In next few minutes, I will tell you why debt mutual funds is silently becoming one of the most powerful investment tool, how they can beat your fixed deposit, and how you can smartly use them to grow your money and protect your wealth. Namaste friends, I am Rohini and you're watching the knowledge series of Fincash.com. Think of debt mutual funds as a professional lender, but instead of lending to one person, it lends to government, large companies, and financial institutes through securities and bonds. Now, every debt fund is driven by two main forces. One is credit risk, that is how safe is the borrower, and second is duration risk, how long your money stays invested. So when you invest in a debt fund, you're basically becoming a part of lending system where your returns come from the interest paid by borrowers and the market value of those bonds. Unlike fixed deposit, debt funds return aren't fixed, but over time they have proven to be far more stable than equities and more flexible than fixed deposit. Now let us understand that why during falling interest rate, debt funds are usually preferred. When interest rates are high, inflation starts cooling, and this usually signals the start of a new cycle. At some point, Reserve Bank of India, that is RBI, begins to cut rate to support growth. And that is when things get interesting. So here is what happens. When the interest rate prices go down, the bonds price go up, and that pushes the debt funds NAV higher. So if you invest before the rate cut begins, you get two benefits. One is steady interest income, and second is capital appreciation as bond price rises. So think of it like buying a property before a metro line opens nearby. Once the infrastructure improves, the prices soar. Even history proves it. Between 2014 to 2016, when RBI cut rates by 175 basis points, long duration gilt funds delivered around 14 to 15% annualized returns. In 2020, when rates fell sharply after COVID, dynamic bond funds even outperformed balanced ones. That is why the best time to invest in debt funds is when interest rates are near the peak and next move looks downward. That's a classic setup where patient investors win big. So based on this, you get 16 plus categories in debt funds that has its own risk and reward ratio. So let us simplify debt funds into three main categories based on how long you plan to stay invested. One is short term, second is mid term, and third is long term. Each one of the category has different purposes. They vary in liquidity, steady income, profit, and risk ratio. Let us look at the first category, that is short-term debt funds. Think of these as your safety parking space. They are perfect for short-term goals, an emergency fund, or idle cash that is just sitting in your savings account. These funds invest mainly in short-term government securities, treasury bills, and money market instrument, which makes them low risk and high liquid. The subtype includes overnight funds that mature in just one day. The second is liquid funds that invest in securities up to 91 days. Then is ultra short and low duration funds that has maturity period of 3 to 12 months. Then you have money market funds that invest in treasury bills, commercial paper, and certificates of deposit which matures within an year. So when do you choose the short-term debt funds? It is when you have an investment goal of 1 year. They offer better returns than your fixed deposit and you can withdraw your money anytime. So short-term debt funds have minimal credit risk and duration risk since their lending duration is very short. The second category is mid-term debt funds. If you're comfortable locking your money for 1 to 4 years, then these funds works beautifully. They aim to give steady, predictable returns with moderate risk. They typically invest in a mix of corporate bonds and government securities, balancing yield and stability. The types of funds here includes short duration funds, where the bonds mature between 1 to 3 years. Then comes the medium duration funds, where the bonds mature in 3 to 4 years. The medium to long duration, the maturity of bond is 4 to 7 years. And dynamic bond fund. These are flexible. The fund manager shifts between short to long duration based on where interest rates are headed. The risk level of this category is moderate. Prices move slightly with the interest rate changes, but the risk is not more than equity category. While choosing a fund, always look for funds that have high rated portfolios, that is called as AA or above, and look for fund that has a history of stable performance across market cycles. Now let's look at the third category, that is long-term debt funds. This is suitable for investors who are okay with short-term volatility for long-term growth. The types includes long duration fund where bonds mature beyond 7 years. Then is corporate bond fund which invests at least 80% in high rated, that is AA plus and above corporate bonds. These are ideal for investors seeking safety and slightly higher return than gilt funds. Then comes credit risk fund which invests in lower rated bonds for higher yields. These are more risky, but if managed well, they can outperform. Then comes banking and PSU funds, which focuses on bonds issued by banks and government-backed institutions and are great blend of safety and returns. Then comes gilt funds, which invest 80% or more in government categories. They have no credit risk but sensitive to rate change. There is also 10-year constant duration gilt funds, which holds only 10-year government bonds. Last but not least, you have floater fund which invests in floating rate bonds. It is great when rates are climbing because your returns grow too. Now before you go and invest in debt mutual funds, let us clear few most common myths that people have, and that's what make them stop investing. So myth number 1, debt mutual funds are like fixed deposit, but they are not. FDs give you fixed rate and those are backed by banks, while debt funds invest in market instruments like government bonds and corporate bonds. So their return do fluctuates little depending on interest rate movement. But here is a twist. Debt funds often outperform FDs after tax because of indexation benefits. That is, if you hold them long term. So they are not the same, they are smarter cousin of fixed deposit. Myth number 2. Debt funds never lose money. So you might have heard people saying that it is debt, so it is safe. But that's not the whole truth. Debt funds can face 2 types of risk. That is interest rate risk when rates go up and bonds prices fall. And the second is credit risk if a company defaults or delays payment. So yes, there is a risk, but it is manageable, especially if you choose top-rated or government-backed funds. Myth number 3, debt funds give low returns. This one is really an outdated. In the last couple of years, categories like dynamic bond fund and gilt funds have given 7 to 8% returns and sometimes even more. That's on par with many hybrid and balanced funds. The point is, debt funds are not about chasing high returns. They are about stability, liquidity, and predictability. And when used smartly, they can make your portfolio far more efficient. Myth number 4. Debt funds are only for old or retired ones. Not at all. If you're in your 20s or 30s, debt funds can be your best friend for your short-term investments, like if you have a goal of vacation, down payment, or an emergency fund. They protect your money from inflation while keeping it liquid. So whether you're a student, a salaried profession, or retired, there is a debt fund for every stage of life. Myth number 4. Debt funds are boring and they do not do much. That's what most people think until they know how it really works. When interest rate falls, the value of existing bonds rises, and debt funds can quietly deliver double-digit returns in those cycles. So, if they are boring, they are brilliantly balanced. See, the biggest mistake people do with debt funds is not that they are investing wrongly, but it is they are not at all investing just because someone told them that debt funds are boring. They reduce volatility, they improve stability, and ensure that your money is always working no matter what the market does. So if you want to explore top performing debt funds, do head to our website. On the home page, you will get an option of explore funds. On the extreme left side, under the category choose debt funds, and you can explore according to the Fincash rating, expense ratio. On the extreme right side, you can customize fund field and you can choose your parameters such as yield to maturity, effective maturity, category ranking, and so on. So debt funds are like friends who doesn't talk much, but when time gets tough, they are always for you. They do not promise crazy returns, they do promise consistency. They do not make you rich overnight, but they do ensure that you stay rich for a lifetime. If you have been ignoring debt mutual funds till now, this is your sign to start now. Start small, stay consistently, and you will be surprised to see that how this category quietly turns your portfolio into a stable one. If this video has helped you to understand debt mutual funds better, then do like, share, and subscribe the channel, because every week we decode money in simple terms and help you become a smarter and a confident investor. It is your money, invest it smartly.